Okay, let's go ahead and begin. Our topic this week was the statement of cash flows. And if you remember all the way back to the beginning of the semester, the very first topic that we had was on financial statements. And we talked in depth about the income statement, balance sheet, and the statement of cash flows. We mentioned that there was a fourth financial statement called the income statement, balance sheet, and the statement of owner's equity. And we mentioned at the time that there was a fourth financial statement called the statement of cash flows, but we didn't do a whole lot with it. It's now time to do something with that fourth financial statement. Let's talk a little bit about the statement of cash flows. Before we can jump into our problem and start pressing some buttons, I think we need a little bit of a foundation. And what you guys learned in the modules this week is that we have three categories of cash flows. Our cash flows can be divided into three different categories. And I think our first step, in order to be able to do the calculations right, our first step is to be able to properly classify the cash flows. So let's take a couple minutes and let's go through what these categories are. Our first category, first classification, would be the operating activities, the cash flows from our operations. And we can define the operating activities as the cash effect of those things that appear on our income statement, the revenues and the expenses. Let's write them. So the cash effect of our revenues and expenses. And to illustrate what I mean by that, let's just assume, let's say that we take a look at an income statement. And the first thing that we see on our income statement is sales revenue. And let's say the amount of the sales revenue, and just to have a conversation, say it was $100. What you need to recognize is that reporting sales revenue of $100 is not the same thing as collecting $100 from our customers. We sell goods on account, which means when the sale happens, we record the revenue. However, we won't collect the cash until a future point in time. So there is a timing difference between when we record the revenue or the expense and when we have the actual exchange of cash. And that's our job for operating activities, is to account for that timing difference, to figure out how much cash did we collect when we report sales revenue of $100. Now, one thing I think you guys need to make note of or put into your notes. On your income statement, there are three what we call non-cash items, three non-cash revenue or expense accounts. Three things that appear on that income statement for which there is no exchange of cash. First one, the big one, is depreciation. Now, we talked about depreciation a couple of weeks ago when we did adjusting entries. And all depreciation is the using up of our buildings and equipment and recording the amount used up as an expense. There is no cash that you pay for depreciation. The other two we've also talked about, losses and gains. A gain or a loss is the difference between the cost of an asset, what we paid to buy it, and what we sold the asset for. You know, if for example, you just think for a second, all right, let's say we went out and we purchased some land and it cost us $5. A couple of years later, we sold the land and we sold the land for $7. Well, that's a $2 gain, right? We sold it for more than what we paid to buy. So we would report a gain of $2. The key point is that's not the cash. The cash is how much we sold it for. The gain or the loss is the difference between what we sold it for and what we paid to buy it. So the gain or the loss, not cash. Same with depreciation. No cash in those numbers there. So one category of our cash flows would be the operating activities. The second classification would be our investing activities. And number two, the investing cash flows. And we can define the investing activities as the cash that we either pay to purchase or the cash we receive from selling. There's going to be three main things that fall into the investing section. Let's write that. So our investing activities, cash paid to purchase, or cash that was received from selling. And like I said, going to be three main things that go into this category. And what the investing section really kind of revolves around are the long-term assets. And we know one category of long-term assets is our property, plant, and equipment, the land, buildings, and equipment. Spending money to buy those things, getting cash from selling those things would be an investing cash flow. But our PP&E is not the only category of long-term asset. We also have the intangibles, the patents, the copyrights, the trademarks. Not nearly as common as PP&E. But anytime there is a cash transaction that involves those things, that is classified as an investing cash flow. So our investing activities include PP&E, intangibles, and then the third thing would be investments. An investment is where we go out and we buy stock in another company. Let's say we go out and we purchase shares of IBM. Well, that purchase of those shares of another company of IBM, we would consider an investment. And the cash we paid to purchase them, and then eventually if we sell them, the cash we get from selling them would be an investing cash flow. So we've seen our operating activities. We have seen the investing activities. And the third category of cash flows would be our financing activities. So the financing cash flows. And the financing activities, well, oops, I apologize, guys. The financing activities, these relate to the folks that fund the organization. That would be our stockholders and the banks, the creditors. So we can define our financing activities as cash that's either received from, or cash that is paid to our stockholders, the investors, and our creditors, the banks. And for this one, let's list out a couple of examples. Let's put down a couple of examples of financing cash flows. And let's start with a couple of inflows here. And remember how we have defined the financing activities. Cash we either get from or pay to stockholders and creditors. An inflow is money I am getting. And I get money from a stockholder when that person invests money into the company. And we have learned in our class, we call that selling them shares of common stock. So one financing inflow, cash received from the sale of our common stock. That is getting money from a stockholder. We get money from a creditor, which is a bank, when we take out a loan. We go to the bank, we say, hey, bank, we'd like to borrow some money. The bank says, you know, that's what we're in business to do. Here's $1 million loan. We now have that cash in our hands. So the other cash inflow that's financing, cash received from loans. Let's also list a couple of outflows of cash. Cash outflows, money we spend that would be classified as finance. And the money that we spend, the money we give to our stockholders, I think you guys know what that is. It's called a dividend. So cash paid for dividends, a financing outflow. The other group that we're going to pay money to is the creditors, the banks. And you know, when they gave us that money, remember we went to the bank, we said, hey, bank, we want to borrow money. Said, hey, that's what we're in business to do. Here's $1 million loan. They don't say, have a wonderful day. They say, here's $1 million loan, pay me back in X number of years. We've got to pay the bank back. But we want to be a little bit careful here. So when we list out our second financing cash flow, it's the cash that is paid as the principal repayment of loans. That is your financing outflow. But I am confident that everybody is aware that when you pay back a loan, you pay it back, and you pay it back with interest. So here's my first question to you for the evening. I didn't include the interest here. I restricted, very restrictive, and said the principal repayment is a financing outflow. So where do you classify the money that you pay for your interest? Can somebody answer that for me? Cash paid for interest. Where is that classified? All right, Keaton, your microphone's on. What is, or where do we classify the cash paid for interest?
It's the operating activities
Why?
because interest is an expense.
Enough said. Good job, Keaton. You can mute your microphone. The interest is an expense. And because it is an expense, the cash we pay for that is an operating cash flow. The repayment of the loan itself, a financing outflow. You know, it comes up quickly, right? Exam 2 is only a couple of weeks away. And I think a really good exam question would be, all right, I'm going to give you a handful of transactions. Let me give you 5 or 6 transactions. And you tell me, is that transaction an operating cash flow? Is it an investing cash flow? Or is it a financing cash flow? Want to be able to tell operating, investing, or financing. In fact, let's test this. Can I please hear from, let's see, Matthew Morton. Matthew, would you please for a minute just turn your microphone on? I've got one quick question for
Yeah.
you. Okay, Matthew, let's see if we can test this little do this experiment. So, Matthew, I'm going to give you a couple of transactions, and I want you to tell me if it's operating, investing, or financing. All right, Matthew, here's first one. Let's say that XYZ company paid $100 to purchase a building. Matthew, tell me, is that operating, investing, or financing?
That's going to be an investing activity.
Of course it is. The building is part of PP&E. So cash paid to purchase the building and investing cash flow. Good job. Matthew, let's do one more. So let's say I give you this transaction. XYZ company received a utility bill in the mail and they paid it. What do you think, Matthew? Operating, investing, or financing?
I think that would be an operating activity because it's an expense.
Enough said. Good job, Matthew. You can mute your microphone, but well done. The utilities would be an expense. So the cash we pay for that is an operating cash flow. Great job. Okay, are there any final questions on the 3 classifications of cash flows? All right, the other thing that we've got to be able to do, we got to be able to press the buttons. Can we please take a look at our example? It says that the following information was taken from the 2025 income statement of XYZ company. And you can see the revenues and the expenses that we had. Underneath the income statement, they give us balance sheet information. So you can see our beginning and ending assets, liabilities, and equity. And what I have asked you to do is use the income statement and the balance sheet to create the statement of cash flows. I'll get us started. And I want to start with our operating activities, the cash effect of our revenues and expenses. So you look at the income statement because that's where you find the revenues and expenses. And the very first one here, no surprise, sales revenue. And we've already heard this evening, reporting sales revenue, whether it is $100 or $500,000, is not the same thing as collecting $100 or $500,000 from your customers. We sell goods on account. So what we're going to need to do is we'll need to set up a T account for accounts receivable. Let's create a T account here for accounts receivable. And I know that accounts receivable is an asset. And the normal balance for an asset is on the debit side of the account. Accounts receivable, beginning balance, 36,000. Ending balance, 40,000. So I can put my 36,000 here at the beginning. And then our ending balance on the bottom left, 40,000. And then the hard part, we have to know, based on the work that we've done previously, why these accounts change, i.e., what transaction will increase our accounts receivable and what transaction will decrease the accounts receivable. And remember what accounts receivable are. They represent money owed to me. And more money will be owed to me every time we make a sale. When we sell goods to our customers, they now owe us that money. So the amount of sales revenue would be the increase to our account. The decrease, well, remember what accounts receivable are. Money owed to me. So the decrease would be whenever the customer pays us. When they pay us, well, they don't owe that money to us anymore. And the accounts receivable comes down. So our cash collections from customers, the decrease side. And you guys, when you're doing your operating section, you're going to have a lot of T accounts. And you'll always know one of the two sides. Our income statement has told us sales revenue, 500,000. Which allows us to solve for the other side, the side that we need to know, the cash collections from customers. And honestly, by now, what is this, like week 7, week 8? By now, you should know exactly how to work a T account. I'll write out the arithmetic for this one, but this is something you should be able to do. 36,000 plus the increase, 500,000 minus the decrease of X equals 40,000. Solving for X, the cash that we collected from our customers, $496,000. That's the game. Do you guys have any, before we move on, do you have any questions on what I did there? But we're going to work our way down the income statement. And the next account listed, cost of goods sold. This one's a little bit tricky. I'll give, does somebody want to take a shot at it? I'll give somebody a try if they want to. How do you go about doing the calculation with cost of goods sold? Matthew, excellent. Your mic's on. Matthew, first question. What account from the balance sheet, Matthew, does cost of goods sold relate to? And hence we'll need a T account for.
So we would start off with an inventory account.
Cost of goods sold is the cost of inventory that we sell to our customers. So let's create a T account for inventory. Matthew, what type of account is inventory?
It would be an asset account.
An asset. And so Matthew, tell me, normal balance, debit or credit?
Would have a normal balance of debit.
So the asset normal balance on the debit side of the account. And for inventory, we had a beginning balance of 42,000 and an ending balance of 50,000. Matthew, next question. Tell me, what transaction, what would we do that would cause our inventory balance to go up?
We would have to buy more inventory.
Go to our supplier and buy more, right? When we purchase more inventory, we have more inventory and the balance in the account increases. So our increase side would be what we purchase. Good. Matthew, next question. On this side, the decrease side, what transaction would cause a decrease in our inventory balance?
Selling it.
That's why we buy it, right? We buy it so we can turn around and sell it to somebody else. And when that inventory is sold, it no longer belongs to us. So the decrease side would be the cost of goods sold. Matthew, good job. Stay with me. I have a few more questions. But we do know from our income statement that the cost of goods sold was $300,000, which lets us figure out the purchases of inventory. And when you solve for X, the inventory that was purchased, well, that looks like $308,000. Matthew, a great job, but we're not quite done, because that 308,000, there's no arguing that that is what we purchased. But that's not the number I'm looking for, Matthew. This does not represent the cash that we paid to our suppliers. How come?
Because we most likely bought a lot of that on account.
Just like we can sell to our customers on account, when we buy inventory, we can buy on account too. So while we can absolutely say that's what we purchased, we cannot say that's the cash that we paid to our suppliers. Matthew, great job. Next question. Turn the mic back on. So Matthew, we need to use another T account. Always, 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 always. Whenever you get this calculation, if you do it right, always use two T accounts. One is the inventory account. Matthew, what is the other T account to use?
It would be accounts payable.
Now we got to go to accounts payable. And let's figure out how much cash we actually paid our suppliers during the year. Matthew, accounts payable. is what type of account?
It is an expense account,
I'll
or
give you
no, it's a liability account. So it's
that's a much better answer. Tell me, Matthew, normal balance is where?
it would be credit.
Absolute liability, normal balance, credit side. And we know that for accounts payable, our beginning balance was 64,000. The ending balance, 58,000. Matthew, just a couple more things and then we'll be good. So great job. A couple more. Accounts payable, what we owe to our suppliers. Why would that balance go up? What would you do where you would owe more money to your suppliers?
You would be purchasing more inventory from them.
You buy stuff. When you buy stuff, you are now obligated to pay for stuff. So just like he said, the purchases would be the increase to accounts payable. And Matthew, last thing for you, why would the liability balance go down?
It would be going down from us paying it off.
When we pay it off, when we give the money to the suppliers, we don't owe it anymore. And that liability decreases. Matthew, that was an outstanding job. You can mute your microphone. Well done. So the decrease here would be the cash that we actually paid for our inventory. And if you guys don't mind, just look up here for just a quick second. The reason we need two T accounts is we need this purchases number. And the only way to get that purchases number is to get it from the inventory account. So we set up the inventory account to figure out our purchases. I will then take that purchases number and bring it over to accounts payable. So this is 308,000. Which lets me then solve for what I need to know. The cash we actually paid for our inventory, which would be $314,000. And that's a really good calculation. So Matthew, again, good job. Watch for that one. It's, you know full well it's going to be on quiz 3 or 4. And you know full well it's going to be on exam 2 in 2 weeks. And there are going to be way too many folks on that exam that are going to tell me the cash paid for inventory is $308,000. And that's wrong. Those folks will only do the inventory account and figure out the purchases. Don't be one of them. You've got to bring that into accounts payable to then determine how much cash was paid for inventory. All right, are there any questions on that calculation? That's a good one. Take a look at the next 2 items on the income statement. Depreciation expense, loss on sale of investments. Both depreciation and a loss are examples of non-cash items, things we do not pay cash for, which in this case we like because there's nothing to do. Ignore them, pass them by. If I asked you, how much cash did you pay for depreciation? You tell me 0. There is no cash paid for depreciation. However, the last 2, those are things we got to pay cash for. The salaries expense and the income tax expense. And I'd like to do those. I kind of want to do them simultaneously. so we can take a look at how this is done. So we've got to match up the income statement accounts to what's on, or to an account on the balance sheet. And it's actually pretty easy to do. Salaries expense corresponds with salaries payable. Income tax expense corresponds with income taxes payable. So I want to set up a T account for my salaries payable and for my income tax payable. And they are both liabilities. So I know the normal balance is on the credit side of the account. For salaries payable, beginning balance was 10,000. Ending balance 12,000. For income tax payable, beginning balance was 9,000. Ending balance was 6,000. And here's the thing about these expense payable combinations. They all work the same way. So the increase to our liability would come from the cost of that item. So the cost of our salaries for the year would increase salaries payable. The cost of the taxes for the year would increase income tax payable. And the cost of those things are found in the expense amount. So the amount of salaries expense represents the increase side to salaries payable. And then it's the same logic down here, the amount of income tax expense. Would be the increase side of income tax payable. The decrease side, well, these are liabilities. So they go down when you actually pay the money. So cash paid for salaries, the decrease here. And cash paid for taxes, the decrease here. And we know from our income statement the amount of the expense. Salaries expense, 50,000. Income tax expense, 32,000. Letting us then solve for the cash paid for those items. We can figure out the cash paid for salaries was 48,000. And the cash paid for taxes $35,000. So yeah, whatever expense payable combo you got, I could have put utilities expense on that income statement. And you would have set up a T account for utilities payable, solved it in the same way. I could have put interest expense on the income statement. And you would have set up a T account for interest payable and solved it in the same way. Are there any questions on what I did here? Well, I think then we can start building this thing. We've gone through the entire income statement, found the cash effect for everything, ignoring those two non-cash items that we had. So let's start creating the statement of cash flows. And we can begin with the operating section. So our operating activities. And we had one source of cash. One place we got money from. We collected $496,000 from our customers. So we can say the cash collected from customers, an inflow money we got, totaling $496,000. And then we have what? 1, 2, 3. 3 things we paid money for. We paid $314,000 for our inventory. Say cash paid for. Our outflows. $314,000 paid for inventory. I'll put my outflows in brackets. We paid $48,000 to our employees for their salaries. And we paid $35,000 to the government for our taxes. The inflows minus the outflows gives us our net cash flow. We can say net cash flow from the operating activities. Add the inflows, subtract the outflows, and we have a net cash inflow here of $99,000. Are there any questions on anything we did in the operating section? You know, when you think about it, the way that you will see this on the test, I give you that. I could give you something that looks just like that. Here, use this information for questions 1, 2, and 3. Question number 1. Calculate the cash collected from customers, and you would need to come up with $496,000. Question number 2. Calculate the cash paid for your income taxes, and you would need to come up with $35,000. Question number 3. Calculate the cash paid for inventory. Don't tell me that it's $308,000. That's coming back with a big red X drawn right through it. You would need to come up with the correct number, $314,000. All right, let's turn to the second category of cash flows, our investing activities. So the investing cash flows. And I'll tell you, in our problem, we have 2 of them. 2 things that are investing. Can somebody give it a stab and give me one? Pick out one thing that is considered an investing cash flow. Grant, excellent. Your mic's on. Grant, what do you have?
Our PP&E.
PP&E. Grant, stay with me. Half the battle, Grant, is knowing where to look. And we wrote out at the beginning of our discussion tonight where to look. Investing activities include these three things. First one is PP&E. Grant, what PP&E asset do we have in our problem?
I see equipment.
I see equipment too. I don't see any land. I don't see any buildings, but I do see equipment. And Grant, one more question for you, if you don't mind. I see that the equipment beginning balance was 200,000. Ending balance went up to 280,000. Grant, here's my question. Does that mean we have purchased more equipment, or does it mean we have sold some of our equipment?
I think it means we purchase more.
I think that sounds like a good answer. Grant, and that makes sense. That's why we have more at the end of the year than what we started with. Because during 2025, we purchased more. Grant, if you don't mind, just one more question, easy one, just to make sure we're all on the same page. The purchase of equipment, would that be considered a cash inflow or a cash outflow?
Be a cash outflow.
We're buying the equipment, so we're giving up the money to whoever we're buying it from. Excellent job. So we know that one of our investing activities would be the cash paid to purchase equipment. And that, just like Grant said, is an outflow, so we'll put that in brackets, of $80,000. That was how much the equipment account increased by from beginning to end of year. As I said earlier, half the battle is knowing where to look. So Grant said, you know what? We got to look for the PP&E. Check it off, it's done. There were no land or buildings, and he took care of the equipment. Then we have to look for the intangibles. Good news. There's no patents, copyrights, or trademarks in this problem. Then finally, we have to look for investments. Not so good news. There are investments in the problem. And I want you guys to look at this. The investments account has gone down in balance. Beginning of year was 164. End of year was 150. So unlike the equipment where the balance went up, this one went down. And when the balance goes down, what that tells me is we must have sold some of our investments during the year. That's why we have less at the end of the year. Some of those investments were sold. And I know that when we sell investments, we will be getting cash from whoever we sold them to. So that'll be an inflow. Cash received from the sale of our investments. And then that will let us figure out the net cash flow from our investing activities. I'll give some. I think this is the toughest calculation in the problem. So I'll give somebody a shot. They want to try. You don't get it right, you don't get it right. Who cares? But if somebody wants to give it a shot, how much cash did we get from the sale of the investments? And I will tell you, the answer is not 14,000. How much cash did we get from the sale of the investments? Does anybody want to give that a try? Matthew Morton. Matthew, what do you think?
It would be $4,000 because we had a loss on sale of investments.
That is a great job. Matthew, I want to put a couple things up here, and then I'd like to ask you just a follow-up question. But he says, all right, start by looking at the investments account. And we saw a few minutes ago, the balance went down. That's how we knew we sold some. The balance went down by $14,000. And that represents our cost. How much the investments that we sold, how much they cost us when we bought them. So I do know that the cost of the investments that were sold was $14,000. But that's not what I'm looking for. That's how much they cost us when we bought them. I want to know, how much did we get from selling the investments? I need to try to figure out the selling price. Now, I don't know what that is. So we're going to try to come up with that. But I do know the difference between what we paid to buy the asset and what we sold the asset for is a gain or a loss. And in our problem, they told us we had a loss on the sale of investments of $10,000. So I do know that we reported a loss of $10,000. Matthew, would you turn the mic back on, please? Matthew, when you sell something at a loss, does that mean we sold the asset for more or for less than what we paid to buy it?
You would sell it for less than what you bought it for.
Of course, that's why we have a loss. And we reported a $10,000 loss from the sale of investments that cost us $14,000. The only way we could do that is if the investments that we sold were sold for $4,000. That is how we would get to our $10,000 loss. Matthew, great job. If you don't mind, can I one more question, please? Matthew, what if, and you guys don't write this, I'm going to just change something real quick. I use a different color here. What if this $10,000, instead of being a loss, what if that $10,000 had been a gain? Are you able to tell me in that case how much cash we would have gotten from the sale of the investments?
Would you have gotten $14,000?
I'll give you one more chance. I don't think it's 14,000. Matthew, let me see if I can push you just a little bit. You told me a minute ago, when you sell something for a loss, you sell it for less than what you paid to buy it. So selling for a $10,000 loss, well, we paid to buy for 14, so that was $4,000. A gain is the opposite. When you sell something at a gain, you sold it for more than what you paid to buy it. So if we had a gain on the sale of investments of 10,000, are you able to tell me what we sold the investments for?
Would it be $24,000?
That sounds like better answer. Good job, Matthew. You can mute your microphone, but excellent job. I thought that was the toughest calculation we had to do tonight because you had to put a couple of pieces together. If you sell it for a gain, you got more. You got, in this case, 10,000 more than what you paid to buy it. So our selling price would have been 24,000. But that's not what happened, right? We sold it at a loss. So we got 10,000 less than what we paid to buy. So the cash that we received from the sale of the investments was $4,000, giving me a net cash flow from investing activities, a net outflow of 76,000. That was a good one. Actually, that's a really good one there. Before we move on to financing, any final questions on our investing activities? All right, good work. So the last category of our cash flows would be the financing cash flows. Remember what they are, we wrote them out. The cash either received from or paid to our stockholders and our creditors. And I will tell you, in our problem, there are 3 financing cash flows. I'll give somebody a shot, except I'd like a new voice if I can. New person. Can you pick out one for me? One financing cash flow in the example we're working. All right, Abby, excellent. Your microphone's on. Abby, give me one.
Common stock.
It should be the first thing you look at. Common stock, the most common of your financing cash flows. And when your common stock balance goes up, like we have right here, owners have invested more money into our business. So in this case, what is that, a $50,000 increase? So we can say the cash received from the sale of our common stock, that's an inflow of 50,000. All right, Abby, good job. Well done. There's still 2 more. Somebody else want to give me another financing cash flow in our problem? Any takers? Well, I say, this is easy, but I gotta remember, where to look. In the financing cash flows, what we get or pay to our stockholders, that's your common stock, and our creditors, that's your bank loans. And we know that a bank loan is called a note payable. And we do have this right here. The short-term note payable. Doesn't matter if it is short-term or long-term, a note payable is a bank loan, making it a financing cash flow. And when you look at these numbers, the note payable balance has gone down from 160 at the beginning of the year to 120 at the end of the year. The decrease in the balance indicates we have paid off some of that loan. Hence, we have an outflow of cash. We can say cash paid on the short-term note payable be an outflow of $40,000. The final financing activity is one that you want to remember, because this is one that's not going to be given to you. You'll have to figure it out. And what it is what you paid in dividends. Now, nowhere in the problem does it say anything at all about dividends. We'll come back to that page in a minute. But we do know that we can figure out the dividends using our old friend, retained earnings. So let's set up a T account for the retained earnings. And by now, this is old hat to us. Beginning retained earnings, given $27,000 plus net income minus dividends equals the ending retained earnings given is $34,000. And we know from our income statement right here, the net income was $48,000, which lets us figure out our dividends. And when you solve for the dividends, we get $41,000. Like I said, that's one you want to remember. When, there's no if, it's when you get the question on quiz 4 and exam 2 to calculate the net cash flow from financing activities, you look for the common stock, you look for your bank loans, the notes payable, and you figure out the dividends. Now that we know the cash we paid for dividends, bring this back. We have this one final financing cash flow. So cash paid for dividends. An outflow of $41,000. Which lets us figure out the net cash flow from our financing activities. And we have a net cash outflow here. $31,000. Now we're not quite done. We got one more step to go, but we've done most of the work. Any questions on any of this work right here? Once you build the 3 sections, the last step is to calculate your net change in cash. And actually, this one's kind of easy because all it is adding the 3 sections together. We had a net inflow from our operating activities of $99,000. We had a net outflow from investing activities of $76,000. It's like adding a negative number. So we'll add in negative $76,000. And we had a net outflow from financing, $31,000. Again, adding a negative number. Which will give me a net change in cash, a net decrease of $8,000. And can I ask, and I'll take anybody on this, but one more question. In our particular problem that we've done tonight, how does this final net change in cash that we came up with, this -8, this decrease of 8,000? What about this number should make us feel pretty good that we have done this correctly? Grant, can you tell me what is it that this should sort of tie to?
If you look at the balance sheet and look at cash on January 1st and December 31st, it should be the same.
See, good job, Grant. You guys see that? Your cash account, beginning of year, 38,000. End of year, 30,000. So according to the balance sheet, the cash went down by $8,000. Exactly what we calculated from our statement of cash flows as the net change in cash. All right, last thing, then I'll be quiet and you guys are good to go. But the statement of cash flows, there's a good bit of work, a lot of work that goes into it. I think for the most part, it's fairly straightforward. You got to get the practice in. You don't get the practice, so it's not going to be straightforward. But it's something that you should be able to handle with a little bit of practice without too much trouble. All right, guys, that is what I had for you. If you are done for the night, have a fantastic evening.